Centerra Gold Inc. has successfully completed a fundamental strategic transition, moving from an organization burdened by significant geopolitical and legal risks to one focused on high-quality, long-life mining assets situated predominantly within stable, Tier 1 jurisdictions. The definitive resolution of the prolonged legal dispute concerning the Kumtor mine in the Kyrgyz Republic eliminated a substantial, decades-long source of volatility that had structurally depressed the company's valuation. This complex settlement involved the Kyrgyz government gaining 100% ownership of the Kumtor mine and its operating companies, along with certain cash payments from Centerra. Crucially, the agreement stipulated the cancellation of all associated legal proceedings across all jurisdictions without any admission of liability. The result of this strategic de-risking is a permanent alteration of Centerra's operational risk profile. Previously, the exposure to jurisdictional uncertainties in Central Asia necessitated that investors apply a high country risk premium, elevating the company's perceived cost of capital when valuing its entire asset portfolio. With the Kumtor dispute finalized, the remaining operational base is anchored by the Mount Milligan gold-copper mine in Canada, the Öksüt gold mine in Turkey, and the advancing Goldfield project in the United States. These jurisdictions, Canada and the USA being top-tier and Turkey being OECD-aligned, offer a significantly more predictable regulatory and legal environment. The structural improvement derived from this geographic stability supports the thesis that the market should begin to lower the risk discount applied to Centerra's cash flows, paving the way for a substantial re-rating toward industry average multiples. 1.2 Q3 2025 operational performance. The third quarter of 2025 demonstrated the earning power of the streamlined asset base, coinciding with a highly favorable commodity price environment. Consolidated gold production for Q3 2025 totaled 81,773 ounces. The operational strength was centered on the high-margin Öksüt mine, which contributed 49,234 ounces of gold. The Mount Milligan mine supplemented this output, producing 32,539 ounces of gold along with significant copper byproducts. Operational efficiency remained well managed despite inflationary pressures common across the mining sector. Consolidated all-in sustaining costs on a byproduct basis were reported at $1,652 per ounce for Q3 2025. This figure aligns favorably with the company's consolidated full-year guidance of $1,650 to $1,750 per ounce. Detailed cost analysis reveals that Öksüt continued to be a lower-cost producer within the portfolio, reporting Q3 AISC of $1,473 per ounce. Meanwhile, Mount Milligan's performance was also robust, with management expecting its full-year AISC to be near the low end of its guidance range of $1,350 to $1,450 per ounce. This cost discipline confirms the high quality of the remaining assets and their inherent resilience against volatile external factors. Detailed analysis of the income statement. 2.1 Revenue generation and commodity leverage. Centerra's Q3 2025 financial results illustrate strong top-line performance driven by both consistent production and exceptionally favorable realized metal prices. Revenue for the 3 months ended September 30, 2025 reached $395.2 million. On a year-to-date basis, revenue for the 9 months totaled $912.1 million. The critical factor underpinning the quarterly results was the pricing achieved on metal sales. The company sold 80,598 ounces of gold at an average realized gold price of $3,178 per ounce. This price realization was significantly higher than the prevailing market benchmarks and contributed directly to outsized profitability. Additionally, copper sales amounting to 13.2 million pounds were executed at an average realized price of $3.73 per pound. This analysis highlights Centerra's acute sensitivity to commodity prices. With consolidated AISC at $1,652 per ounce, the cash margin generated per ounce of gold in Q3 was a striking $1,526. This exceptionally wide margin is a direct function of the realized gold price of $3,178 per ounce. The large operating leverage implies that the majority of any future increase in gold prices above $2,500 per ounce will drop directly to operational cash flow and net profitability, making Centerra a highly leveraged instrument for investors anticipating continued strength in precious and base metal prices. 2.2 Cost structure and operating margins. The cost of goods sold structure demonstrates healthy operating leverage. Production costs for Q3 2025 were $223.4 million. When set against the quarterly revenue, this resulted in substantial earnings from mine operations totaling $136.4 million. Further down the income statement, non-cash expenses, specifically depreciation, depletion, and amortization, DDA, were reported at $35.4 million for the quarter. The ratio of DDA to operating earnings suggests that the company's capital-intensive asset base is being amortized at a predictable pace relative to its production output. The cost structure, when measured by the adjusted EBITDA of $145.8 million for Q3 2025, confirms that the core mining business generated robust earnings before considering non-operating factors and non-cash charges. 2.3 Quality of earnings by section. Reported Q3 2025 financial results include a material discrepancy between statutory net earnings and adjusted figures, which requires careful interpretation to accurately assess sustainable profitability. The company reported net earnings of $292.2 million, translating to $1.44 per share. However, adjusted net earnings, a non-GAAP measure meant to reflect core operations, were significantly lower at $66.4 million, or $0.33 per share. The difference of $225 million between these two figures represents substantial one-time non-cash gains or losses. Considering the timing of the quarter and the coincident finalization of the Kumtor agreement, this large positive variance almost certainly originates from accounting adjustments related to the Kumtor divestiture. Such gains typically involve the reversal of previously booked impairment charges, the derecognition of liabilities related to the disputed asset, or other final settlement accounting treatments. For institutional investors, it is paramount to utilize the adjusted net earnings of $66.4 million as the true indicator of the ongoing repeatable earnings capacity of the current operating assets. This affirmation underscores that the remaining asset base is indeed highly profitable and cash generative on a normalized basis. Cash flow generation and capital allocation strategy. 3.1 Operating cash flow strength. Centerra's cash flow statement provides unequivocal evidence of the underlying operational strength of the Mount Milligan and Öksüt mines. Cash provided by operating activities, OCF, reached $161.7 million in Q3 2025. This quarterly performance is particularly striking when compared to the year-to-date OCF of $205.6 million for the entire 9 months ended September 30, 2025. This suggests that Q3 alone contributed approximately 78% of the company's cumulative operating cash flow for the year, an extreme acceleration driven by the combined effects of strong production and the high realized metal prices referenced previously. This velocity of cash conversion is a defining characteristic of Centerra's current financial profile.
3.2 Free cash flow, FCF, and internal funding. The conversion of OCF into free cash flow, FCF, was exceptionally high during the quarter, indicating that the vast majority of cash generated by operations flowed through as surplus capital. Centerra reported Q3 2025 FCF of $98 million. Again, the quarterly FCF was extremely strong, exceeding the year-to-date FCF of $91.6 million reported for the first 9 months. This robust FCF generation is the linchpin of management's core strategic pillar, a self-funded growth strategy. The third quarter results validate this strategy completely. Total additions to property, plant, and equipment, PP&E, representing the entire capital expenditure program for the quarter, amounted to $56 million. The fact that this $56 million in total capital investment was comfortably exceeded by the $98 million in FCF generated in the same quarter confirms the company's ability to finance its operational maintenance, sustaining capital, and all non-sustaining growth projects entirely from internal cash flows. This preserves shareholder value by eliminating reliance on external debt markets or dilutive equity issuances to fund major asset development, ensuring financial independence and long-term capital preservation. 3.3. Disciplined Capital Expenditure Program. The quarterly capital expenditures reflect a balance between sustaining the existing operations and advancing future growth. Total capital spending, additions to PP&E, of $56 million was segmented into sustaining and non-sustaining components. Sustaining capital expenditures amounted to $25 million for Q3 2025. These investments were crucial for maintaining the long-term viability and output of the existing mines. Examples include ongoing construction activities at the Tailings Storage Facility (TSF) at Mount Milligan and the expansion of the heap leach pad at Öksüt. Separately, non-sustaining capital expenditures were $32 million. This non-sustaining capital was primarily directed toward the development of the Thompson Creek mine, demonstrating active deployment of capital toward the next generation of production assets. The disciplined allocation of capital, fully funded by operational cash generation, provides a compelling testament to the company's prudent financial management and clear path for asset maturation. Balance sheet strength and financial resilience. 4.1. Exceptional liquidity position. Centerra Gold maintains one of the strongest balance sheets in the mid-tier mining sector, a position reinforced by the successful monetization and de-risking resulting from the Kumtor settlement. As of September 30, 2025, the company reported a substantial cash and cash equivalents balance of $561 million. Total available liquidity is even higher, incorporating $400 million available under an undrawn corporate credit facility. This brings Centerra's total liquidity pool to an impressive $961 million. This nearly $1 billion in liquid resources provides an extensive financial buffer, allowing the company to manage potential operational disruptions, unexpected capital increases, or a significant downturn in commodity prices without financial strain. 4.2. Debt structure and coverage. The company's debt profile is pristine, reflecting a highly conservative financial policy. There are no material long-term debt obligations, and the $400 million corporate credit facility remains entirely undrawn. This near-zero net debt position results in exceptionally strong financial solvency and liquidity metrics. Analysis of the current and liquidity ratios confirms this strength. The quick ratio stands at 2.05, and the current ratio is robust at 2.89. These figures indicate that Centerra has the immediate resources to cover its short-term obligations multiple times over. Furthermore, the interest coverage ratio is reported at a massive 382.49x, underscoring the negligible financial risk inherent in the capital structure. The availability of nearly $1 billion in liquid resources, the $561.8 million in cash, plus the undrawn $400 million facility creates significant strategic optionality. This liquidity positions Centerra as a powerful and flexible participant in the mergers and acquisitions market. Unlike many peers in the cyclical mining industry that require equity dilution or leveraged financing to fund expansion, Centerra can pursue opportunistic, accretive acquisitions to expand its North American and Turkish footprint, all while maintaining its financial independence and conservative risk profile. 4.3. Asset retirement obligations, AROs, and asset base. The company's asset base reflects continued investment and development activities. The net book value of property, plant, and equipment (PP&E) increased materially, rising from $1.10 billion at the beginning of 2025 to $1.37 billion as of September 30, 2025. This growth in capitalized assets includes additions to PP&E totaling $180.4 million during the 9 months ended September 30, 2025. In terms of environmental and closure liabilities, asset retirement obligations, AROs, and reclamation liabilities represent long-term costs inherent to mining. The expense related to reclamation and remediation accretion at operating sites was $5.9 million in Q3 2025. Given the quarterly operational cash flow generation, this expense is minor relative to the company's profitability, suggesting that the long-term financial risk associated with environmental liabilities is being proactively managed and sufficiently covered by cash generation. 5. earnings growth trajectory and project pipeline. 5.1 Historical volatility versus future growth. Centerra's historical performance suffered due to the protracted geopolitical crisis, which is reflected in a negative past 5-year EPS growth rate of -2.60%. This metric captures the period of legal and operational uncertainty that culminated in the Öksüt divestiture. However, the forward-looking earnings trajectory exhibits a dramatic and positive inflection, structurally driven by the removal of the major risk overhang and the high-margin output from the stable asset base. The consensus forecast for near-term EPS growth is exceptionally high. Analysts project a year-over-year YOY increase of plus 37.86% for 2025, accelerating to plus 43.52% for 2026. This steep acceleration is highly indicative of the positive impact of the de-risking process and the full realization of operational efficiencies within a favorable pricing climate. Looking further ahead, the estimated long-term EPS growth rate for the next 5 years is forecasted at a robust 22.40%. This projected growth suggests that the expected re-rating is not merely a short-term cyclical recovery, but rather a sustained structural improvement in the company's financial profile driven by committed capital projects. 5.2 Long-term cornerstone asset, Mount Milligan. The foundation for Centerra's long-term value is the Mount Milligan gold-copper mine in British Columbia, Canada. Its strategic importance was reaffirmed by the pre-feasibility study (PFS) published in September 2025, which extended the estimated life of mine by approximately a decade, pushing the projected closure date out to 2045. The PFS assigned a substantial valuation to this cornerstone asset, confirming an after-tax net present value of approximately $1.5 billion. This valuation is based on conservative long-term price assumptions of $2,600 per ounce of gold and $4.30 per pound of copper. The LOM extension and robust NPV affirm Mount Milligan's position as a low-risk, long-life asset that underpins the company's future cash flow profile and justifies significant capitalized investment for decades to come. Proven and probable reserves at Mount Milligan increased significantly to 4.4 million ounces of gold and 1.7 billion pounds of copper, representing a 56% and 52% increase respectively from year-end 2024 figures. 5.3 Accelerating near-term gold production, Goldfield. Centerra is accelerating development on its Goldfield project in Nevada, USA, designed to provide a near-term boost to its production profile. The technical study completed in August 2025 confirmed very strong project economics, including an after-tax NPV 5% of $245 million and an attractive after-tax internal rate of return of 30%. This valuation is based on a long-term gold price assumption of $2,500 per ounce. The project benefits from low execution risk due to an optimized crushing strategy and a relatively simple flow sheet, coupled with its location in a top-tier mining jurisdiction. Goldfield is expected to deliver a crucial increase in gold production in the near term, filling a critical component of Centerra's growth pipeline.
The combined, explicitly quantified net present value NPV 5% of the two key assets, Mount Milligan $1.5 billion and Goldfield $0.245 billion, amounts to $1.745 billion. When this conservative asset value is compared against the company's approximate market capitalization of $2.67 billion USD, it strongly suggests a material undervaluation. The difference of roughly $900 million in equity valuation is left to cover the stable, highly profitable Öksüt operation, the $561.8 million cash hoard, and the entire exploration and development pipeline, including Chemis and Thompson Creek. This gap demonstrates substantial embedded value that has not yet been reflected in the share price, supporting the fundamental case for a significant future multiple expansion driven by successful project execution. V. Dividend safety and return of capital policy. 6.1. Dividend sustainability and coverage. Centerra's capital allocation strategy prioritizes prudent financial flexibility, which is reflected in a highly conservative yet safe dividend policy. The company has approved a quarterly dividend of C0.07 per common share. The aggregate cash requirement for this dividend in Q3 2025 was approximately $10.3 million USD. The safety of this dividend is exceptional. When assessed against the $98.7 million in free cash flow generated during Q3 25, the FCF coverage is approximately tenfold. This extremely low payout ratio, approximately 10.4% of FCF, confirms that the dividend is structurally secure, even under moderately adverse commodity price scenarios. The conservative stance ensures that the vast majority of operational cash surplus can be retained to fund the internal growth pipeline and opportunistic capital returns, effectively acting as a substantial buffer against future commodity price volatility. 6.2. Strategic use of share repurchases, NCIB. A key complement to the conservative dividend policy is the aggressive deployment of surplus capital through share repurchases, a mechanism known as the normal course issuer bid. In Q3 2025, Centerra repurchased 2.84 million common shares for a total consideration of $22.1 million. Recognizing the continued undervaluation of the stock, the board of directors increased the approved level of share repurchases through the NCIB for 2025 to $100 million. Furthermore, the company has declared its intention to renew its NCIB, subject to TSX approval, to purchase for cancellation a significant number of shares, representing the greater of 5% of the issued and outstanding shares, or 10% of the public float. Deploying substantial cash toward buybacks at the current low valuation multiples, PE 8.1x, is inherently accretive to earnings per share, EPS. This strategic action increases the intrinsic value for remaining shareholders, confirming management's belief that the company's own stock represents the best current investment opportunity for their surplus capital. V. Valuation profile and investment conclusion. 7.1. Multiple analysis and peer comparison. Centerra Gold trades at valuations that imply a substantial discount relative to both its industry peers and its underlying fundamental growth profile. The trailing price-to-earnings ratio is reported at 8.1x. This contrasts sharply with the peer group average PE of 20.6x, highlighting a significant disconnect in market perception. The forward PE ratio, which incorporates near-term earnings growth, is slightly higher at 10.21x, but remains deeply discounted relative to the sector. Similarly, the cash flow valuation multiples are attractive. The price to operating cash flow, POCF, is 7.79x compared to the industry average PCF of 12.91x. This confirms that Centerra's stock price is cheap relative to its ability to generate raw cash flow. When incorporating projected growth, the divergence becomes even more pronounced. The PEG ratio, price divided by earnings divided by growth rate, for Centerra is 0.57. A PEG ratio below 1 generally signifies that a company is undervalued relative to its growth prospects. Although the mining industry itself often trades at low PE ratios, Centerra's 0.57 ratio, combined with its expected near-term EPS growth exceeding 40%, strongly indicates that the market has not yet priced in the dramatic structural improvements and future profitability. 7.2. Analyst targets and PNAV implications. Current analyst price targets provide a benchmark for near-term expectations, though they may not fully capture the longer-term re-rating potential. Based on short-term forecasts, the average price target for Centerra Gold is $13, with a high target of $17.75. Another consensus average price target is $14.17. These targets represent a modest upside from the current closing price of approximately $12.93. The fundamental value assessment suggests that the stock is profoundly undervalued based on its underlying asset base. As established, the after-tax NPV 5% of the two core development assets, Mount Milligan and Goldfield, alone approaches $1.75 billion. This tangible, quantifiable asset value consumes the vast majority of the company's current market capitalization. This pronounced PNAV implication demonstrates that the equity value is still being heavily penalized by a structural risk premium, despite the successful and comprehensive resolution of the Kumtor dispute. Achieving even a modest industry-standard PE multiple, for example 12 or 15x, would imply a significant re-rating potential of 46% to 83% from current levels. Continued execution on high-return projects like Goldfield and sustained FCF generation are the most immediate catalysts required to compel the market to close this valuation gap. 9. Conclusions. Centerra Gold Incorporated represents a highly compelling value proposition, offering a rare combination of structural de-risking, robust financial health, and an accelerating self-funded growth profile, all trading at a significant discount to intrinsic value. The company has successfully executed a transformative strategy by divesting the Kumtor asset, which has significantly reduced geopolitical risk and structurally lowered the applicable cost of capital to its remaining portfolio. This cleaner risk profile is now anchored by two high-quality, long-life assets, Mount Milligan, LOM to 2045, NPV $1.5 billion, and Öksüt, complemented by the near-term Goldfield project, IRR 30%, NPV $245 million. Financially, the company is exceptionally strong. Q3 2025 results confirmed a self-funded growth model, generating $98 million in free cash flow that comfortably covers all sustaining and growth capital expenditures. The balance sheet boasts $561 million in cash and nearly $1 billion in total liquidity, providing significant M&A optionality and financial resilience. Both dividend safety and accretive share repurchases, NCIB, are well covered, ensuring optimal deployment of surplus capital. The current valuation multiples, including a PE of 8.1x and a PCF of 7.79x, fail to account for the forecast near-term earnings growth exceeding 40% or the substantial, quantifiable net asset value in its development pipeline. The stock is currently being penalized by a historical risk premium that is no longer justified by the operating environment. The investment thesis is centered on the inevitable multiple re-rating as the market internalizes the realized de-risking and the successful execution of the internal high-return project pipeline. Principal risks. The principal risks remain the sector's cyclical exposure to commodity price volatility, as Q3 profitability benefited significantly from a realized gold price of $3,178 per ounce, and the inherent operational execution risks associated with developing large-scale mining projects.